Ladies and gentlemen, something just happened in the silver market that hasn't happened in 45 years, and almost nobody is talking about it. While the headlines focus on stocks and AI, a historic signal may be flashing in precious metals. Is this the beginning of a major shift in wealth, or just another false alarm? And why would comments from Jamie Dimon matter in a market that most investors ignore? Stay with me, because what you're about to hear could completely change how you look at silver. For decades, silver has had a remarkable habit of moving when the majority of investors least expect it. It spends long periods trading quietly, often overlooked while attention is directed toward technology stocks, real estate, or the latest financial trend. Then, almost without warning, it begins to shift in a way that catches nearly everyone off guard. History shows that the biggest moves in silver rarely begin with excitement, they begin with disbelief. What makes the current situation so compelling is that we're looking at a market signal that has not appeared in approximately 45 years. Events like this are exceptionally rare. Markets generate noise every single day, but genuine long-term signals are different. They don't occur every few months, and they certainly don't appear every year. When something happens that hasn't been seen in nearly half a century, it deserves careful attention rather than emotional reactions. The first instinct for many investors is to assume that history simply repeats itself. In reality, history doesn't repeat perfectly, but it often rhymes. The economic conditions may be different, the technology may have changed, and the financial system may be more complex than it was decades ago, yet human behavior remains remarkably consistent. Fear, greed, confidence, and uncertainty continue to drive markets just as they always have. One of the biggest mistakes investors make is focusing only on price. Price tells you what happened today. It doesn't always tell you why it happened or where the market may be heading over the coming years. To understand silver, you have to look beneath the surface. You have to examine supply, demand, monetary conditions, industrial consumption, mining economics, and investor psychology. These factors work together, often building pressure long before prices reflect the underlying reality. That's why long periods of quiet trading should never be mistaken for weakness. In many cases, they represent accumulation. During these phases, informed participants gradually build positions while public interest remains low. Financial media rarely cover these periods because there isn't an exciting story to tell. Yet these are often the moments that matter most. By the time headlines begin celebrating silver, a significant portion of the move may already have taken place. The significance of a 45-year signal isn't that it guarantees immediate gains. No honest market observer can promise that. Markets never move in straight lines, and silver has always been known for its volatility. Sharp advances are frequently followed by corrections that test the conviction of even experienced investors. Understanding this reality is essential because volatility is not necessarily a sign that the larger trend has failed. It's simply part of how this market behaves. Another important factor is timing. Investors often become frustrated because markets rarely operate on personal schedules. Fundamentals can improve for months or even years before prices fully respond. This disconnect causes many people to lose patience and exit positions just before momentum begins to build. The market has a way of rewarding patience while challenging emotion. Today's environment adds another layer to the story. Global debt levels remain historically high, governments continue running significant deficits, and central banks face increasingly difficult choices. Inflation may fluctuate from year to year, but concerns about preserving purchasing power have not disappeared. These broader economic conditions create an environment where tangible assets naturally attract greater attention over time. Silver occupies a unique position because it serves two roles simultaneously. It has a long history as a monetary metal, yet it is also an essential industrial commodity. Modern technologies depend on silver's exceptional electrical conductivity and other unique physical properties. From renewable energy systems to advanced electronics and medical applications, demand continues to expand across multiple industries. This creates a dynamic unlike many other commodities. At the same time, increasing production is far easier said than done. Developing new mines requires years of exploration, permitting, financing, and construction. Existing operations face rising costs, declining ore grades, and regulatory challenges. Even when prices rise, additional supply cannot appear overnight. This imbalance between growing demand and limited production capacity has the potential to reshape the market over the long term. Investor sentiment also plays a critical role. For years, silver has remained outside the focus of most mainstream portfolios. Institutional allocations have generally been modest compared with equities or bonds. Retail participation has also fluctuated dramatically depending on market enthusiasm. When interest eventually returns, the available physical supply may prove much tighter than many expect. This is why experienced market participants spend more time watching trends than chasing headlines. Headlines often describe what has already happened. Trends reveal what may still be developing. A rare historical signal should never be viewed in isolation, but when it aligns with improving fundamentals, shifting investor psychology, constrained supply, and growing industrial demand, it becomes increasingly difficult to dismiss. Of course, no investment is without risk. Silver can experience significant price swings, and short-term volatility should always be expected. Anyone entering this market solely because of excitement or fear is likely to struggle when inevitable corrections occur. Successful investing requires discipline, realistic expectations, and an understanding that wealth is generally built over years rather than days. The real lesson from this historic development isn't that silver is guaranteed to reach a specific price. The lesson is that markets occasionally present conditions that deserve serious attention because they occur so infrequently. A signal that has remained absent for roughly 45 years reminds us that extraordinary opportunities often emerge quietly before they become obvious to everyone else. Whether this marks the beginning of another major chapter for silver will only be known with time, but history suggests that ignoring rare developments has often been more costly than taking the time to understand them. When influential figures from the banking world speak about the economy, markets tend to pay attention. Their words alone do not determine the direction of financial markets, but they often reflect concerns that are already developing beneath the surface. Large financial institutions have access to enormous amounts of economic data, lending activity, corporate behavior, and consumer trends. While no individual can predict the future with certainty, comments from leaders of major banks can provide valuable insight into how experienced market participants view the broader financial landscape. Over the past several years, the global economy has become increasingly difficult to navigate. Interest rates have moved sharply after a prolonged period of historically low borrowing costs. Governments around the world continue to carry record levels of debt, while businesses and consumers face higher financing expenses than they became accustomed to during the previous decade. These changing conditions affect everything from housing and manufacturing to corporate investment and consumer confidence. One of the greatest challenges facing policymakers is balancing economic growth with inflation control. Raising interest rates may help reduce inflationary pressures, but it also increases borrowing costs, slows investment, and can weaken economic activity. Lowering rates too quickly, on the other hand, risks reigniting inflation and reducing confidence in the purchasing power of currencies. This balancing act leaves central banks with increasingly limited room for error. Financial markets often react long before economic statistics confirm a trend. Investors constantly reassess risk based on expectations rather than current conditions. If confidence begins to weaken, capital naturally seeks stability. Throughout history, tangible assets have often attracted renewed attention during periods of uncertainty because they exist independently of financial promises or government obligations. This does not mean traditional financial assets lose all value. Stocks, bonds, and businesses remain essential components of the global economy. However, diversification becomes increasingly important when uncertainty rises. Investors who rely entirely on one asset class expose themselves to risks that may not be immediately apparent during periods of economic optimism. Silver occupies an interesting position within this broader discussion. Unlike many investments, it benefits from both monetary demand and industrial demand. During periods of economic expansion, manufacturing and technology sectors support consumption. During periods of financial uncertainty, investors may increase allocations to precious metals as part of a broader risk management strategy. This dual role gives silver characteristics that are uncommon among major commodities. Another issue attracting attention is the continued expansion of government debt. Debt itself is not inherently negative. Governments, businesses, and households all borrow to finance growth and investment. Problems arise when debt grows faster than the economy's ability to support it. Servicing higher debt becomes increasingly expensive as interest rates rise, placing additional pressure on public finances and limiting future policy flexibility. Markets recognize these realities even when political discussions focus elsewhere. Investors understand that long-term fiscal sustainability matters because it influences confidence in currencies, government bonds, and financial stability. When uncertainty surrounding debt increases, hard assets frequently receive renewed consideration as part of a balanced portfolio. Banking itself has also changed significantly over recent decades. Digital transactions, global capital flows, and increasingly interconnected financial institutions have created a system that operates with remarkable efficiency during stable periods. However, greater complexity can also increase vulnerability when unexpected events occur. Problems that begin in one segment of the financial system may spread much faster than in previous generations. This interconnected environment encourages sophisticated investors to think beyond quarterly earnings reports or short-term market movements. They evaluate structural trends that may unfold over many years. Questions surrounding demographic change, energy demand, supply chains, fiscal policy, and monetary stability become just as important as day-to-day market volatility. Silver fits naturally into these discussions because its value is influenced by multiple long-term forces simultaneously. Industrial demand continues expanding through technologies that require high electrical conductivity and durability. At the same time, investors monitor monetary conditions that may encourage greater interest in precious metals. These overlapping drivers create a market that responds to more than a single economic variable. Supply conditions deserve equal attention. Bringing new mining projects into production is neither quick nor inexpensive. Exploration, environmental approvals, infrastructure development, financing, and construction often require many years before meaningful production begins. Existing mines also face declining ore grades and increasing operational costs. These factors limit how rapidly global supply can respond even if prices strengthen significantly. Meanwhile, industrial consumption continues regardless of investor sentiment. Manufacturers purchase silver because they need it for production, not because they expect prices to rise. This steady demand creates an underlying foundation that differs from purely investment-driven markets. Investor psychology remains one of the most underestimated factors in financial markets. Confidence can shift surprisingly quickly. During periods of optimism, risk assets attract widespread attention, while defensive assets receive relatively little interest. As uncertainty increases, priorities often change. Preserving purchasing power becomes more important than maximizing returns, leading investors to reconsider assets they may have previously ignored. It is important to avoid assuming that every warning automatically leads to a financial crisis. Economic systems are remarkably resilient and have demonstrated an ability to adapt through changing conditions. Businesses innovate, consumers adjust spending habits, policymakers modify strategies, and markets continuously absorb new information. Predicting imminent collapse has proven just as unreliable as assuming uninterrupted prosperity. The more balanced approach is to recognize that uncertainty is a permanent feature of investing rather than an occasional exception. Preparing for multiple outcomes generally produces better long-term results than attempting to predict a single future scenario with absolute confidence. This perspective encourages discipline instead of emotion. Rather than chasing headlines or reacting impulsively to every market fluctuation, thoughtful investors evaluate underlying fundamentals, maintain diversified portfolios, and remain patient as longer-term trends develop. Silver is not a magic solution, nor is it immune to volatility. It is simply one asset whose characteristics may become increasingly valuable during periods when economic and financial uncertainty rise. Ultimately, the broader financial picture extends far beyond any single executive, institution, or economic report. It is shaped by the interaction of monetary policy, fiscal decisions, industrial demand, investor confidence, global debt, and resource availability. Understanding these interconnected forces provides a stronger foundation for evaluating opportunities than focusing on short-term market noise. When experienced observers raise concerns about the economy, the most productive response is neither fear nor complacency, but careful analysis grounded in history, fundamentals, and a clear understanding of how financial systems evolve over time. Bull markets rarely announce themselves at the beginning. They usually emerge quietly, developing beneath the surface while most investors remain focused on yesterday's winners. By the time public enthusiasm reaches its peak, a substantial portion of the move has often already taken place. This pattern has repeated throughout financial history, and silver has demonstrated this behavior more dramatically than many other assets. One of the strongest arguments for the possibility of a new bull market in silver is the growing imbalance between supply and demand. Markets function according to a simple principle over the long term. When demand expands faster than supply can respond, prices eventually adjust. The adjustment may not happen immediately, and it may not occur in a straight line, but persistent imbalances have a way of influencing markets over time. Silver occupies a unique position because it is both a precious metal and an industrial material. Unlike assets whose value depends primarily on investor sentiment, silver benefits from practical applications across numerous industries. Manufacturers require it because of its exceptional electrical conductivity, thermal efficiency, and resistance to corrosion. These characteristics make it difficult to replace in many advanced technologies without sacrificing performance. The transition toward greater electrification has become another important factor. Renewable energy systems, electric vehicles, advanced electronics, telecommunications equipment, and expanding data infrastructure all require significant quantities of silver. As these industries continue to grow, industrial consumption increases regardless of short-term fluctuations in financial markets. This creates a steady source of demand that did not exist on the same scale several decades ago. At the same time, increasing production presents significant challenges. Mining is not an industry capable of responding overnight to higher prices. Discovering economically viable deposits requires years of exploration. Once discoveries are made, companies must secure financing, obtain permits, build infrastructure, and construct processing facilities before meaningful production begins. These steps often require a decade or more, depending on the jurisdiction and complexity of the project. Existing operations face their own obstacles. Many mature mines are producing lower grade ore than in previous years, meaning more material must be processed to recover the same amount of silver. Energy costs, labor expenses, environmental compliance, and equipment maintenance continue to rise, increasing the overall cost of production. These realities limit how quickly global supply can expand, even if stronger prices encourage additional investment. An important characteristic of the silver market is that a large percentage of annual production comes as a byproduct of mining other metals such as copper, lead, and zinc. This means silver output often depends more on the economics of those primary metals than on silver prices themselves. Even substantial increases in silver prices do not automatically result in proportional increases in production because many mining decisions are driven by broader market conditions. Investor behavior represents another powerful influence. During extended periods when silver receives little media attention, institutional allocations often remain relatively modest. Retail investors may also focus on more popular asset classes, offering immediate momentum. Yet market psychology can shift rapidly. When confidence in traditional financial assets weakens or inflation concerns increase, interest in precious metals frequently returns. The size of the silver market makes these changes particularly significant. Compared with many global financial markets, silver represents a relatively small pool of investable assets. As a result, even moderate increases in investment demand can have an outsized impact on prices. This characteristic helps explain why silver has historically experienced periods of exceptional volatility during major bull markets. Physical availability also deserves attention. Paper markets facilitate efficient trading and price discovery, but physical metal ultimately represents the foundation of the market. When investment demand rises simultaneously with industrial consumption, available inventories may tighten. Under such conditions, buyers compete for limited supply, creating additional upward pressure over time. None of this suggests that prices move upward without interruption. Quite the opposite. Silver has earned a reputation for sharp corrections even during powerful long-term advances. These pullbacks often discourage inexperienced investors who mistake temporary volatility for a change in the underlying trend. Experienced market participants recognize that corrections are a normal feature of nearly every sustained bull market. Patience